Today's topic is equity finance and the share market. So in the past we talked a lot about bond finance, and now we're going over towards equity finance. There are basically two forms of finance, as we said beforehand. So we have debt finance, which is bank loans, credit and bonds. So we've covered all these. These are borrowed funds, so we promise to repay them back in the future, including interest. And the alternative way of finance is equity finance. So there we are selling shares of our company. And we can imagine that quite literally. So it's not only the paper and the securities and shares that are being sold, but partial ownership of that company is being sold. So that's the difference between the two. So which one is more important? Here are the numbers. So this is Australia net equity raising. So that's how much new equity finance came into the company for new projects. So you can see here, it looks quite impressive, very high bars. It distinguishes between financial, so they are basically banks getting new equity in, and non-financial other companies that are getting equity in. And over here, we have bond issuings. These are companies that use bond finance and how much. And we can see here, well, also large numbers, but this one looks more impressive. Plus, in the news, I think, what do you hear more often? Do they talk about the share market or the bond market? Share market is on the news all the time. But now if you look at the numbers here, especially for non-financial corporations, so here in between it was 25 billion, but if you look here, usually it's under 10 billion each year. So on average, I reckon around 6-7 billion maybe is what companies, non-financial companies, raise in equity each year. And if you look at the numbers over here, bond issuing, on average, more closer towards 20, so say maybe 18 billion. And that is just what's raised in Australia. Lots of companies are raising funds, issuing bonds overseas, and then the numbers get even bigger. So basically we have to add these two numbers up, and then we get around 40 billion on average is being raised in the bond market, while in the equity market it's around 7. So you see here the bond market, bond finance, much more important, even though it's not that much in the news. And that's worth keeping in the back of your head. Now, comparing the numbers has been slightly unfair because these are the net numbers and these are the gross numbers. I couldn't find the net numbers here for this one fast enough, but still the basic message holds. The bond market is actually the bigger market compared to the share market. When it is about raising finance for companies to get fresh money in. The simplest thing of getting equity finance in is basically selling ordinary shares, normal shares. So here's one example that I will use a little bit later that I made up. So these are securities. Securities is just a different word for a promise or contract. Just imagine it as a piece of paper. That represents part ownership. So in my example here, I will sell soon this piece of paper, which is going to represent 100% ownership. So whoever holds this piece of paper owns 100% of this company later. And in the real world, it's a similar thing. So if you buy a share in Westpac, you don't earn 100% of Westpac, but you earn a small fraction of Westpac. If you buy a share in General Motors, same idea. You own a small part of General Motors, and so you're becoming a partial owner. Now, what's the advantage of being a partial owner? Well, you've got a vote when they do the general meeting, so you have a say which direction the company should go. But you can imagine if you hold 0.00001% of the company, you don't have too much of a say. If you hold 30% of the company, you've got much more of a say, of course. Now you have the right to receive dividends. If they're paying dividends, there's no guarantee that they're paying dividends. There's certain risks if you hold shares. The value of these shares is simply a function of the expected future returns. And it's also considered risky or risk capital for the following reason. There's no guarantee that you will get dividends in the future. Maybe the company is doing very well, creates lots of profits, and is deciding to pay a lot of dividends. Well, then you receive lots of cash flows in the future. Maybe the company is doing very well, but decides not to pay out any profits. There's lots of companies right now, well, Amazon is not making that many profits, but they generate a lot of revenue, but they're not paying out any kind of dividends. Still, that company is doing well because their share price keeps on going up. So people who have shares in Amazon usually quite happy. And then there's other companies that might not do that super well, and they pay neither dividends nor does their share price go up. So it's risky for you because there's no promise that you get a certain amount of interest or fixed dividends. You also have the lowest payment priority. What does that mean? If the company ever gets into trouble, it's become insolvent, everybody else is getting paid first. So first the bondholders are getting paid, the employees are getting paid, all kinds of other companies that delivered goods to that company are getting paid, and only if there's then assets and wealth and money left over, you might get some money too, as the initial owner of that company. So that makes it much more risky to hold shares than to hold bonds, for example. Now, if you compare the two, I compared them from the viewpoint of the company, and I changed it slightly towards the book 2. So debt finance, that's what we used in the past. Think of the bonds here. The advantage here is they're considered cheaper for the company. Why is that? Because if the company is paying interest, it's part of a cost for them, cost of the bond finance. And these costs are reducing your profits. So if you have higher costs, you have lower profits. If you have lower profits, it means you pay less profit tax, because you pay tax on your corporate profits. So that means that interest payments are reducing your tax burden, and that makes bond finance artificially a little bit cheaper compared to equity finance. Then leverage can increase return on equity. Let's just keep that in the back of your head for the time. We do a practical example when we talk about banks for this one. Disadvantages of bond finance, well, we have to repay the bonds. For example, if it's a 10-year bond, you have to repay it after 10 years, and then you're not sure if you can get money back again by selling new bonds. Maybe in 10 years' time, nobody wants to have your corporate bonds, and then you're in trouble to get finance back into the company. That's different to equity, because equity you never repay. These shares hold forever, so you don't have to worry about finding refinance when you use equity finance. Potential loss of secured assets. So behind these bonds, there's a lot of small print. One of the small prints is, for example, if you're not being able to pay interest and to pay the bond back properly, then you have to hand over assets, like a building or part of the company, towards the bondholder here. So there's a chance that you're losing part of your company, which is a disadvantage, and also might force you to sell some assets to get enough money in to repay the bond. So all these disadvantages you do not have when you use equity finance. So there's no promise that you ever repay anything, no promise that you repay any dividends, but therefore on the flip side, in order to sell these equity shares, you have to kind of, well, not promise that you give a higher return, but in the end, the people that buy these shares, they do want to get a return, and they want to get a higher return than the bondholders because equity is more risky. And remember, if something is more risky, we want to get a risk premium on top. So in the end, equity is going to be more expensive for the company. So the company has to make a decision how much bond and equity finance to use, but that is the topic of corporate finance. We don't go any deeper in this class with that choice. In this class, we just want to know that there are these two different types of finance, and there's advantages and disadvantages to them. Good, there's so-called ordinary shares and there's so-called preference shares. And I want to skip preference shares in this class. If you want to read a little bit deeper, you can read up on them. So preference shares have a little bit more privileges and rights than ordinary shares, but also some disadvantages as well. Ordinary shares are the normal ones. So again, you're a partial owner. Therefore, you have a say, for example, at the general meeting. You also can attend the general meeting, even if you've got a single share that gives you a right to go to these general meetings. Maybe you're lucky and there's a sausage sizzle as well. And maybe you don't get dividends, but you get some free food and some free entertainment. There's no maturity date, so these run forever. You can usually sell these shares and securities to somebody else, so you can transfer the ownership. There's limited liability. Now that is very important. Let's forget about the fully paid for the time being here. That just means that you really did pay for the security when you bought it. But limited liability is important. Now what does that mean? If you are a partial shareholder, let's say in VW, Volkswagen in Germany, so they had a little bit of trouble with their emissions and they might have to pay huge fines to the US Department of Environmental Protection and similar in Europe, so they are a little bit in trouble. If you have shares in that company, and now the company doesn't have enough money to pay the fines, what does limited liability mean? basically means that nobody can ring at your door and say, listen, you have got to pay more money now. The worst thing that can happen is that the share price is falling to zero. So your liability, your potential loss is limited to whatever you paid for the share, not a single dollar more. And that's different, for example, if you have a private company with your own name on it, where you are basically the company. Because now if the company gets into trouble and you have to pay, they might ring at your door. So that's the difference between basically a corporation. It's a legal entity by itself, and if you've got a private company when your name is on it. So that's one of the major reasons why they do this, limited liability. And that's going to be very important later down the track when we talk about banks too, and banks' choice of risk. What's the entitlement here? Well, if they pay dividends, you're entitled to a certain fraction of the dividends. So if you own 100% of the company, you get 100% of the dividends. If you own 10% of the company, you get 10% of the dividends, and so on. You've got a vote, also usually in proportion to how many shares you've got. And you've got the potential for capital gains. So if the company becomes more and more valuable, like for example Amazon in the past, the financial wealth that you hold in that company is growing too. So if the share price goes up, of course you're happy. If the share price goes down, not so much. Your turn. So let's make that a little bit more practical. Let me see what we've got here. So you can get out your wallets already. We do now a little game with real money. So we've got that company that I prepared before class, and I want to sell that company now simply via these shares here. So if you buy the share, you own 100% of this company. Now how much is that company worth? We don't know for sure. So we need to get an expert to audit that company first, right? An auditing company, and I do a quick audit now. And I can tell you that company is worth between 0 and $10, 10 Australian dollars. So it's for sure not worth $11, and it's for sure, well, you can hear already, it's not going to be $0 either. Now, how do we do this game? Basically, I'm auctioning this off in a second, and at the end of the class, you get that company. Whoever holds the share, 100% ownership, is getting this company. So it's similar to the game that we did with bond. We use real money here. Real money is going from you to me, and later on, the company is going to you, to the owner of the share. And we allow for trading of the share in between too. Let's make a start. First offer. How much? $3. Anybody more than 3? FPOS? No, sorry, I don't have an FPOS terminal with me today. But you can try to sell some bonds to somebody else to get some finance yourself quick. $5? So you do it with counting, that's a bit quicker. 5, 1, 2, 3, done. Very good. So the company stays with me for the time being, but the ownership goes to you. So let's see what we have now. Primary versus secondary market. We talked about that one when we talked about bonds too. So we've got a primary market and a secondary market. What did we do just now? Were we active on the primary market or were we active on the secondary market? Primary market, because I sold the share for the first time. I was the company in this moment. I issued shares and the finance went to the company, to me. Secondary market is if you're selling your shares now to somebody else. By the way, do you want to sell it to anybody else yet? Not yet, I imagine. Well, let's make it a bit more interesting. So another quick audit. I'll give you a little bit more information. There's no paper money in here. Are you interested to sell the share to anybody else? Or anybody else wants to offer more or less than $5? No, we stay put for the time being. Good. Good. Emerging firm. So what's an emerging firm? That is a firm that is just starting out and that is starting to sell equity. In this case here, we had a proper security. You can imagine it making it just like a contract too. I think like they had on the Facebook movie. They had, with the first 2 or 3 people at Facebook, they basically written a contract or a verbal contract. You contribute your computer, I contribute my time, and therefore we own 50% of the company, or 40, or whatever they made up. Anybody remembers this one? That garage, famous garage? Which company is behind that one? Microsoft, close by. They had a different company close by. A different garage, sorry, I wanted to say. This is not the Microsoft garage, but Apple. So this was of, I think not Steve Jobs, but his friend, Josviak, place where they started out with the Apple company, and you can imagine at the time, not that big. But still, they needed some equity, they needed some finance, they needed some computers, they needed some food, they needed to get going with the company. So they first put in their own equity, in this example here, literally their own space they used for the company. And later they started pulling in a little bit more equity from other people as well. So partial ownerships. Then these companies hopefully get bigger and bigger and bigger, and they look for more capital because they need more computers, they want to start producing overseas and so on. So then they are looking for venture capital. So these are still, should I say small companies? Well, small enough that they're not at the stock exchange yet. And they're just starting out. It's also sometimes called seed funding, like growing a seed. And there's two types of these venture capitals. One is where they just look for capital, for finance coming in. And I imagine that was the case in Apple in the beginning. And the other one is where they look also for some people that have connections, have management skills. They know how to grow a company bigger. So they might not know how to do software, but they might know how to get a company larger over time, how to get organized. And then we call this one a business angel. So a business angel not only plows in their own money and gets partial ownership of the new company, but they also put in their own time and expertise. And an example for that one is maybe what they have on tellies, the Dragon's Den, right? Or in Australia, it's what's that called, Shark Tank, where they basically have 4 well-established businessmen that are deciding if they want to put their own equity, if they want to finance a company against partial ownership of their company. And on top of that, they put in their expertise as well. Now, why would people be interested in providing venture capital? It's very, very risky, but there's also a chance of high returns. So we usually see the high return story when people say, well, if you bought Apple shares in, or if you bought very early on into Apple, if you bought very early on into Bitcoin, Facebook, and so on, you would have been rich now. You always see these stories of people that had like a tiny share in these companies, and they get very, very rich. What's very important here is not to forget is that most of these startups fail. It's not that if something is a startup, they will become huge and famous companies. Most of the startups go down. And that's what's meant here by high risk, high return. So you put in your money in hundreds of different companies. Most of them go bankrupt, but if you're lucky, one of them might do really, really, really well. Now, the goal with these things here is basically to get them investment ready. What does that mean? That means we want to get a company to grow. We're going to get effective management in place, the size, then get proper financial reports, getting a little bit more profitable, though profitability doesn't seem to be that important nowadays anymore. So if you think of Facebook, Amazon, I'll talk a tiny bit about Dropbox later. So these are not really profitable companies yet. They make a lot of revenues, but they have very high costs as well. But people believe that they might become profitable in the future. And they're for sure very large already. And the idea is once they're investment ready, now we can sell official shares, just as we did here now. You can go on the share market. And the hope is, once you go onto the share market, that you can sell the shares at such a high price that people that had partial ownership in their company early on make a huge profit. Let's make an example. Let's say if Apple has been very, very small, the whole company might have been worth, let's say, $1 million. You bought half of that company, but providing you put in a second $1 million, so the whole worth of the company becomes $2 million, and you have half the shares of that one. So $1 million is your contribution, and therefore you've got 50% of that company. Now, if that company is growing to become 100 million, you're still a 50% owner. And if you manage to sell the shares as such that you get now 50% of 100 million in the IPO, you made a huge profit. So that's the idea here. IPO, what does that mean? Initial public offering. So that's what we just did here as well. Just that a real IPO is much more official, of course. So initial means first time, public means to the general public, and offering means you're offering part of your company for the first time ever. And the idea is to raise additional equity capital so the company can continue to grow. And also the nice thing here is that some of the owners now, they have been possibly rich on paper, but of course it's not cash money. And now if you have an IPO, you can sell shares because now the company becomes traded, publicly traded, you can much more easily liquidate part of your ownership. So beforehand you had, let's say, 10% of the company and you're on paper rich, but you don't have any cash. And now you can sell some shares and get cash in. Currently an IPO that is in the news is Dropbox. So they're scratching the head of doing an IPO. Let's look at that one quick.
But not necessarily this. What kind of valuation should it fetch?
And that is the big question, and that's why they brought these advisors in. This is kind of a posturing shift from Dropbox, who has said they have no immediate plans to go public in the past. Now the company has reached out and actually said, come in, talk to us about what this would look like. Back in 2014, in a private funding round, they were valued at $10 billion. That $10 billion.
So let's see at all the information that we've got. So they are not public yet. They're thinking of doing an IPO, going public. Beforehand, they said they had a private round. That basically means instead of selling shares, just like we did in public, they do it basically behind closed doors with some large investors. They're saying, listen, we've got this company. Do you want a certain stake in it, 10, 15%, 5%? How much would you be willing to pay to become partial owner of our company? And at that time, they had been valued, what did you say? I think 10 billion. Let's see.
They were valued at $10 billion.
Yes, so 10 billion. But of course, nobody knows exactly how much they're worth. That's what they said at the very start here too. They're trying to suss out, well, how much is our company worth and how much money could we get in if we're selling part of it.
That $10 billion valuation has been called into question over the years as the company has kind of struggled to grow and find new business lines. And you've seen a lot of the mutual funds who actually invest in Dropbox write down their bookmarking of the valuation. So that.
Now, what does that mean? In the past, part of these private ownership transfers were to mutual funds. So these are big financial institutions. They bought part of Dropbox. And apparently they had write-downs. Write-downs means that in the past they valued, let's say, their share at $100 million. And now they think like, ooh, maybe not, maybe it's more like $80 million. So they already put into their accounting books a 20% loss, which is of course not the best news for the company Dropbox that wants to issue new shares, because they want to show in the public, well, that the company is very valuable.
That is kind of one of the #1 things on the docket, according to my sources, that they are asking about. If we go out, are we going to have to take a big haircut? Because that's not necessarily good for morale or for customer perception on the business.
Now, a big haircut is not what I've got yesterday, but big haircut here means basically what I said. So you have initially a value, let's say $100 million, and now you decrease that value to $90 million. That means you had a 10 million haircut. When we talk about, or when you watch news about the Greek debt crisis, it's a similar thing there too. So on bonds, sometimes that can happen too. If a bond goes into partial default, they call that also a haircut. Basically means that you lose some of your value.
Now, is it the case that it still doesn't make a profit, but it does have close to $2 billion of revenue?
Drew Houston said at the Bloomberg Tech Conference this summer that they are not profitable. He did say they are cash flow positive. So that is a step in the right direction. And when you look at, this slow year of tech IPOs in the U.S., investors have really been calling for more fundamentally sound businesses if they're going to give on valuation. Getting to cash flow positive, eventually getting to profitability or showing a path there will be key for CEO Drew Houston and Dropbox before they can even think to venture to public markets.
So we've heard they're not making a profit yet, and of course profitability is important because we can get dividends only out of profits in the future. And the whole point of buying shares is that sooner or later you hope to get dividends. You might say, well, I don't need dividends, I might just sell the share to somebody else at a higher price. But the only reason why somebody else is willing to buy that share from you is because they are hoping to get profits and dividends in the future. So there's no way around it. Sooner or later, you want to see profits. So if a company can't show that they're going to be profitable in the future, and by a large extent profitable, it would be hard for them to raise any equity. Now, how does the whole thing work? In this class, it was very easy. I just auction it off. In real life, much, much, much harder. So you have to arrange it first. You have to find investment banks. For large IPOs, you usually have to get several investment banks together to help you to place your shares on the share market and to prepare everything. So you need lots of documents, the so-called prospectus. That's hundreds of pages thick, has a lot of information about the company. You can't just all make that up. There needs to be a lot of due diligence, so you need auditing companies, lawyers. Everything has to be triple and double checked. It costs a fortune to do these things. Basically, you might think of 5 to 8% of all the money that you raise is just going straight out for costs. So it costs a lot to get these IPOs going. On the other hand, the investment banks, always very happy to do IPOs because they earn a lot organizing these things. So that's the reason why you can also see that we don't have IPOs that often. Number one, for each company you can have an IPO only once in their lifetime because it's the initial, the first one. And also not that many companies do it. So lots of companies simply stay small and only a few companies get to that point where they can get big enough to go onto the share market. So we see that only once in a while. From the investment bank point of view, there's two ways of organizing these IPOs. One is so-called best effort, and the other one is called underwriting, standby or underwriting contract. Now, what's the difference between the two? Best effort basically means there's no guarantee that the new shares are being sold or at which price they're being sold. The investment bank is simply saying, we're doing our best to sell the shares for you. And that's different with the underwriting contract. With the underwriting contract, there is a certain guarantee where the investment bank is saying, listen, even if you're not able to sell it in the regular share market, we are promising we buy then all the leftover shares at a fixed price, at a certain price. So then the risk is going onto the investment bank. And you can imagine then they will charge much, much, much higher fees on top because of that risk. So your turn. Okay, let's see. So I should make another audit. So I can see golden coins, and let's see how many, 1, 2, I see 2 golden coins and at least 5 silver coins. That's the information I can give you. And we open the market again. Number one, do you want to sell it, the shares, and at which price? 6. Anybody who wants to buy the security off him for $6? 1, 2, 3. No, not going to happen. Now let's see what the share market price in this moment will be. There was no trade, so we can't really see a price, but for sure the price cannot be under $6 right now. Wouldn't also be over $6, so let's just keep it at $6 for the time being. So we started with 5, now we're at 6. You can't get these shares for under $6.